The year 2008 witnessed a financial earthquake that shook the world. It was a crisis like no other, a financial meltdown that brought the global economy to its knees. We call it the 2008 market crash. But what really happened? Imagine a house of cards built precariously high, waiting for a gust of wind to topple it over. That was the state of the financial system before the crash. Years of risky lending, reckless borrowing, and complex financial instruments had created a bubble waiting to burst. When the bubble finally burst, the consequences were catastrophic. Stock markets crashed, banks collapsed, and businesses shut down. Millions of people lost their jobs, their homes, and their life savings. The world was plunged into the worst economic recession since the Great Depression. At the heart of the crisis was a phenomenon called the housing bubble. For years leading up to 2008, house prices in the United States had been rising at an unsustainable rate. This wasn't normal, something was wrong. Low interest rates and easy lending practices fueled this boom. Banks were giving out mortgages like candy, even to people with poor credit and low incomes. These risky loans, known as subprime mortgages, were packaged together and sold off to investors as complex financial products. As long as house prices kept going up, everyone made money. But what happened when prices stopped rising? What happened when people couldn't repay their loans? The answer, as we soon found out, was a financial disaster of epic proportions. Subprime mortgages were ticking time bombs. These were loans given to borrowers with poor credit histories, low credit scores, or unstable incomes. They were considered subprime because they carried a higher risk of default. Why would banks give out such risky loans? The answer was simple: greed. Banks made huge profits by issuing these loans, packaging them together and selling them off to investors. They didn't care if the borrowers could repay. They just wanted to keep the money flowing. As long as house prices kept rising, the system worked. But as soon as prices started to fall, borrowers began to default on their loans. The house of cards began to crumble. Wall Street played a key role in inflating the housing bubble and fueling the financial crisis. Investment banks, hedge funds, and other financial institutions created and traded complex financial instruments linked to subprime mortgages. These instruments, with names like collateralized debt obligations, CDOs, and credit default swaps, CDSs, were designed to shift risk away from lenders and onto investors. But the complexity of these instruments masked the real risks involved. Wall Street gambled recklessly with these instruments, betting on the continued rise of the housing market. They believed they had found a way to make money without any risk. They were wrong. Section 5. The big players, architects of the crisis. Several key players played a significant role in the events leading up to the 2008 crisis. While it's not accurate to pin the blame on any one individual or institution, certain figures and entities were particularly influential. Alan Greenspan, the Federal Reserve Chairman, had policies of low interest rates and deregulation that are often cited as contributing factors to the housing bubble. Then we have the rating agencies like Moody's, Standard & Poor's, and Fitch. These agencies gave AAA ratings to complex mortgage-backed securities, even though they were incredibly risky. Investment banks such as Lehman Brothers, Bear Stearns, and Goldman Sachs created and traded these complex financial instruments that spread the contagion throughout the financial system. These are just a few of the key players. Their decisions and actions, driven by a combination of greed, miscalculation, and a lack of oversight, contributed to the perfect storm that was the 2008 financial crisis. Section 6. The domino effect, from Wall Street to Main Street. The collapse of the housing bubble and the subprime mortgage market had a ripple effect throughout the entire financial system. When borrowers defaulted on their loans, banks and other financial institutions that held these mortgages suffered huge losses. As these losses mounted, banks became reluctant to lend to each other, fearing that they might not be repaid. This credit freeze brought the financial system to a standstill. Businesses couldn't get loans to operate, and consumers couldn't get loans to buy homes or cars. The crisis quickly spread from Wall Street to Main Street. Businesses shut down, people lost their jobs, and the economy plunged into a deep recession. Section 7. The aftermath, picking up the pieces. The 2008 financial crisis had a devastating impact on the global economy. In the United States, millions of people lost their jobs, their homes, and their life savings. The unemployment rate soared to 10%, the highest level since the 1980s. Governments around the world were forced to intervene, bailing out banks and implementing stimulus packages to try and revive their economies. The road to recovery was long and painful. The crisis exposed the fragility of the global financial system and the interconnectedness of the world's economies. It also highlighted the human cost of financial recklessness and the importance of regulation and oversight. Section 8. Lessons learned never again. The 2008 financial crisis was a wake-up call. It taught us some hard lessons about the dangers of unregulated markets, the importance of financial literacy, and the need for ethical behavior in the financial industry. It showed us that unchecked greed and excessive risk-taking can have catastrophic consequences, not just for Wall Street, but for ordinary people around the world. The question is, have we learned our lesson? Have we done enough to prevent another crisis like this from happening again? Section 9. Safeguarding the future, preventing another 2008. In the aftermath of the crisis, governments and regulators around the world implemented a number of reforms aimed at preventing a repeat of the 2008 meltdown. These reforms included increased regulation with stricter rules and oversight for banks and other financial institutions, particularly in areas like lending practices and risk management, consumer protection measures to protect borrowers from predatory lending practices and to promote financial literacy, and global cooperation with enhanced coordination among international bodies to address systemic risks and promote financial stability. While these reforms have made the financial system more resilient, the threat of another crisis remains. Constant vigilance, responsible lending, and a commitment to ethical behavior are essential to safeguard our financial future. We cannot afford to forget the lessons of 2008.